Hello and welcome to today's episode. I'm your host, and in this session, we're diving deep into one of the most significant sources of market volatility in recent weeks: the impact of Donald Trump's tariffs and the ensuing trade wars. Market volatility is often a double-edged sword. Presents opportunities for traders but also introduces risks that require careful management. The trade policies implemented so far during Trump's administration, particularly the imposition of tariffs on different trade partners, led to drastic price swings across equities, commodities, currencies, and bonds. Understanding how to trade effectively in such conditions is crucial for capitalizing on uncertainty while safeguarding your investments. Understanding the impact of tariffs and trade wars. Trade wars occur when countries impose tariffs or other economic restrictions on each other in retaliation for what they perceive as unfair trade practices. Under Trump's presidency, multiple rounds of tariffs have been imposed, particularly on China, the European Union, Canada, and Mexico. These policies triggered market disruptions due to concerns over supply chains, corporate earnings, and global economic growth. Key economic sectors affected. Trade tensions and tariffs affected multiple sectors in profound ways. Let's break it down. Technology companies heavily reliant on Chinese manufacturing, such as Apple and major semiconductor firms, saw increased costs and significant supply chain disruptions. Agriculture: U.S. farmers were hit hard by retaliatory tariffs from China, which directly impacted exports of key agricultural products like soybeans, pork, and dairy. Automotive tariffs on steel and aluminum caused production costs to rise, squeezing profit margins for car manufacturers. Retail: higher import costs led to increased prices for consumer goods, directly impacting major retailers such as Walmart and Target. Energy: the oil and natural gas sectors faced fluctuations in demand, particularly due to trade tensions affecting exports to China. The psychology of market volatility during trade wars. Understanding investor psychology is key to navigating volatile markets. Reactions to tariffs and trade disputes are often driven by emotions rather than logic. Here are the primary psychological factors at play. Herd mentality: traders react rapidly to breaking news, causing sharp price swings as everyone rushes to buy or sell. Risk aversion: investors shift capital away from risky assets into safer investments like gold and government bonds. Speculative frenzy: some traders attempt to profit from dramatic price movements, increasing overall market volatility. Advanced strategies for trading market volatility during trade wars. 1. Focus on safe haven assets. When markets experience uncertainty due to geopolitical tensions, traders often turn to assets that hold value during instability. Gold prices tend to surge when economic uncertainty rises. U.S. Treasuries bonds typically gain value as investors flee from volatile equities. Japanese yen, JPY, and Swiss franc, CHF. These currencies tend to appreciate during global economic crises. Bitcoin and cryptocurrencies, digital assets, have increasingly been perceived as alternative safe havens. 2. Trade the Volatility Index, VIX. The VIX, also known as the Fear Index, measures expected market volatility. Traders can buy VIX futures or options to hedge against market downturns. Short the VIX when expecting reduced uncertainty. Use inverse ETFs that profit from declining volatility. 3. Implement sector rotation strategies. Trade wars affect some sectors more than others. Adjusting your portfolio accordingly can be beneficial. Bearish positions: short technology, consumer discretionary, and industrial stocks as they suffer the most. Bullish positions: go long on defensive sectors such as utilities, healthcare, and consumer staples. Long-term investments: identify undervalued stocks poised for recovery once trade tensions ease. 4. Exploit currency trading opportunities. Trade war developments significantly impact forex markets. Short the Chinese yuan, CNY. Tariff escalations often lead to yuan depreciation. Buy the US dollar, USD. The dollar strengthens as investors seek stability. Trade emerging market currencies. Countries dependent on Chinese exports like Australia and Brazil see significant currency fluctuations. Hedge with currency derivatives. Use forward contracts and options to mitigate exchange rate risks. 5. Leverage options for risk management. Options can help traders navigate volatile markets while minimizing losses. Buy puts on vulnerable stocks or indices, protect portfolios against market downturns. Use straddles or strangles, profit from large price movements regardless of direction. Sell covered calls, generate income when market uncertainty keeps prices stagnant. Utilize iron condors, take advantage of reduced volatility in stable markets. 6. Monitor trade policy announcements. Government policies and negotiations heavily impact markets. Traders should follow reliable news sources covering trade disputes. Set alerts for major tariff-related announcements. Use economic calendars to track key trade-related events. Analyze central bank responses to trade-related economic concerns. 7. Diversify globally. Given that trade wars impact certain economies differently, geographic diversification can reduce overall risk. Invest in non-US markets that are less affected by tariffs. Consider emerging market bonds that have limited exposure to US-China tensions. Allocate funds to multinational companies with well-diversified supply chains. 8. Use algorithmic trading for an edge. Algorithmic trading can help eliminate emotional decision-making and execute trades efficiently. High-frequency trading (HFT) exploits short-term price inefficiencies. Machine learning models utilize AI-driven analytics to predict market movements. Trend-following algorithms automate trades based on established price patterns. Case study: trading the US-China trade war. History has a tendency to repeat itself. We can predict how the current trade standoff will play out simply by walking down memory lane to Trump's first tenure as U.S. president. During the peak of the US-China trade war in 2018 to 2019, traders observed several significant market behaviors. Equities sold off dramatically whenever new tariffs were announced. Gold prices surged as investors sought safety. Chinese yuan depreciated, prompting forex traders to short CNY pairs. Semiconductor stocks like Nvidia and AMD saw extreme volatility due to their reliance on China. Retailers such as Walmart adapted their supply chains to minimize tariff-related losses. Conclusion: the market volatility triggered by tariffs and trade wars presents both opportunities and risks. To succeed in trading such conditions, it's crucial to understand how different asset classes react to trade tensions, employ volatility-based strategies, and stay informed about key economic events. By incorporating techniques such as trading the VIX, using options, diversifying portfolios, and monitoring geopolitical developments, traders can navigate the challenges presented by economic uncertainty. Harness the market volatility driven by Trump's tariffs and global countermeasures to trade multiple asset classes on a state-of-the-art platform. Visit crystalballmarkets.com. Thank you for tuning into today's episode. If you found this discussion helpful, be sure to subscribe or share this episode with friends, or leave a review and join us next time for more insights into financial markets and trading strategies.